accounting is a great example of how we answer management's question, how are we doing? We're going to look at responsibility centers, cost centers, profit centers, investment centers, and report to management how they are doing. All right, here's our organization chart for Panther Holding Company. Down here at level 5, these are cost centers. All these managers can do is try to control their costs. They don't have any revenue to manage. Same thing for level 4, just costs, except possibly the sales department, which may be considered a profit center, where we're going to look at revenue minus expenses. Then we get up here to level 3. These are called profit centers. We'll look at their revenue minus their expenses to evaluate them. And then levels 2 and 1 are investment centers. We'll not only look at revenue minus expenses, but we'll look at measures like return on investment or residual income. All right, let's look at the January responsibility reports for Panther. And let's start at the top. Let's say that you are in charge of the furniture manufacturing division. And you look at your report and you see that there are 2 big unfavorable variances. First of all, in your own operation, you've got administrative division expenses that are $10,700 unfavorable. So you need to look at your own operation to see what's going on there. You also see that the Selma Sofa Corporation has a $29,500 unfavorable performance. So you're managing by exception. You're going to look into that and see what's going on there. Then let's go down a level. Let's say that you're in charge of Tables Incorporated and you get the monthly report. It looks like the biggest bad news you have to look at is the planning department costs. They have a $2,200 unfavorable variance. Also, you probably want to look at the department manager's salaries. In other words, the people in the sales department, the production department, the planning department, and the accounting department, because they have a $1,200 unfavorable variance. That's how management by exception works. We go down the line and we look for the exceptions. What operations are having unfavorable differences, unfavorable variances? And at the very top, we might take a look at the income statement, and we probably will use, for internal purposes only, the contribution margin format. Sales minus variable costs gives us contribution margin, minus fixed costs gives us net income or operating income. And that's what management will look at the very top at corporate headquarters. And how are we going to evaluate folks? Well, in our investment centers, we're not just going to look at revenue minus expenses. We're going to look at return on investment. And back in 1914, a guy named Donaldson Brown, working with the DuPont company, broke return on investment down. Instead of just operating income over operating assets, he said, let's take operating income over sales times sales over operating assets. And as you can see, the sales in the numerator and the denominator cancel each other out, right back to operating income over operating assets. But by breaking it down this way, we're supposed to see, are we not making enough money on our sales, or are we not getting enough sales from our assets? And it's really important, by the way, when we're doing responsibility accounting, to not include things for which the managers are not responsible. If they can't control something, yet it impacts their budget and impacts their bonus in a negative way, that's going to demoralize our employees. And speaking of bonuses, suppose your division is the star of the company and you routinely earn 20% ROI on your projects, even though the hurdle rate, the target rate for your company is 18%. So a project comes your way that's going to earn 19%, you would decline it because it would reduce your overall return on investment. You're at 20, why would you take on a project that earns 19%? So instead, we might use residual income instead of return on investment. Residual income says, take the predicted operating income from this new project, subtract the operating assets it needs times the desired ROI. In other words, does this thing make more income than the bare minimum? If it does, then it's a good project. Then you as a manager will want to do it. And by the way, it's great to evaluate our cost centers by how are they controlling costs. It's great to look at our profit centers as revenue minus expenses and evaluating that way. And investment centers, let's look at return on investment. Let's look at residual income. But we probably also want to use what's called the balanced scorecard approach. So we don't just look at financial metrics, we look at how they deal with the customers, what their internal processes are, and how their learning and growth is. So the balanced scorecard should be an important part of our responsibility accounting system.